Welcome to vTalkInsight, Market Drivers Daily for June 24th, 2026. Tech volatility has surged to year highs. Micron sits at the center of the AI debate, and record European heat is forcing a rapid rethink of energy resilience. Today we unpack what this mix of market stress and structural change could mean for risk, liquidity, and future return drivers. The tech-led correction we have been tracking has now turned into a full volatility regime shift centered on chips and high-growth names. The Nasdaq 100 Volatility Index is at a 52-week high, with roughly half of June sessions seeing moves of 2% or more, and the semiconductor complex has borne the brunt. The Philadelphia Semiconductor Index and the SOX both dropped close to 8% in a single day, while tech-heavy benchmarks in Asia, including Korean and European chip stocks, have seen similarly sharp swings. Under the surface, leverage and product structure are doing much of the work. Record high volatility in Asian equities, especially in chips, is being driven more by derivatives and leveraged positioning than by abrupt changes in company fundamentals. Leveraged ETFs reportedly sold around $6 billion during the latest rout, amplifying intraday moves, while domestic banks in parts of Asia have started cutting margin for retail clients. In Korea, 3 sizable corrections this year have not broken the broader uptrend, highlighting how structural flow dynamics and local positioning can drive large swings without a clear macro trigger. Globally, price action feels nervous rather than panicked. After the latest sell-off, S&P futures are roughly flat and European indices are only slightly negative, suggesting investors are reassessing rather than capitulating. Some market participants argue the downturn is not the start of a full bubble burst, but they do see room for further near-term downside as crowded positions in AI-related stocks are cleared. At the same time, tech sector concentration risk is prompting a tilt toward high-dividend and previously underowned sectors, especially in Asia, as investors look for alternative sources of return during bouts of elevated volatility. In rates, sovereign bonds are no longer seen as an automatic safety net, so attention is shifting to specific maturities and active duration management to balance yield capture against drawdown risk. Some investors see current levels in 3 to 5-year UK, European, and US bonds as attractive for locking in income in a higher volatility regime, though that view relies on continued policy credibility. Near term, Micron's earnings loom large as a volatility catalyst, with markets focused on AI memory demand, supply tightness, and margin guidance after recent reports of plateauing orders. How Micron trades could set the tone for semiconductors globally, much as the Brexit referendum once reset expectations for currency risk when sterling's move exceeded even the ERM exit. From here, the main watch points are tech volatility indicators, flows through leverage products, and whether upcoming AI earnings stabilize or extend this repricing. The AI narrative is still the dominant growth story, but it is evolving from a broad momentum trade into a more selective, earnings-driven theme. Recent equity gains have been narrowly concentrated in technology and energy, increasing concentration risk, while within AI, there is clear rotation. Capital is shifting from semiconductors toward hyperscalers. Yet the overall impact on the S&P 500 has been limited because these groups carry similar index weights. At the stock level, sharp sell-offs in AI-related chip makers after otherwise solid earnings underline how high expectations have become and how unforgiving markets are when margin or outlook guidance falls even slightly short. On the hardware side, custom silicon is reshaping the competitive field. OpenAI and Broadcom have co-developed a new chip designed specifically for large language model inference, promising much better performance per watt and per dollar than current general-purpose solutions. The design-to-tape-out cycle was only around 9 months, signaling how quickly AI hardware can now be conceived and brought to market. Broadcom expects the trend of AI model developers designing their own chips to become standard, as vertical integration tailors compute to specific workloads, even if that reduces flexibility versus traditional GPU-based approaches and channels more volume to leading foundries. Capital expenditure linked to AI remains on a steep upward path, with hyperscaler investment projected to rise from roughly $730 billion this year toward $1 trillion, supporting demand across semis, networking, and power infrastructure. GE Vernova's gas turbine order book is effectively sold out until 2029 as AI data center developers race to secure dependable power, and all major hyperscalers are actively sourcing natural gas solutions despite environmental concerns and regulatory scrutiny. At the same time, AI-driven automation is already delivering tangible productivity gains in manufacturing, with examples of shop floors achieving up to 50% higher output and 80% better program quality. Partnerships with names like NVIDIA, Tencent's launch of an AI agent for enterprise WeChat, IBM's renewed focus on AI software after an upgrade, and Weaver Systems' guidance hike on strong demand from OpenAI and AWS all highlight how the AI ecosystem is broadening beyond a handful of megacap leaders. In semiconductors, the focus is firmly on whether today's AI windfall is sustainable. Memory makers such as Micron, SK Hynix, and Samsung are enjoying soaring profits and margins as AI demand collides with acute shortages, driving memory prices sharply higher. Micron's upcoming earnings are therefore seen as a bellwether, with markets watching high bandwidth memory demand, pricing, and supply plans to judge whether this is a structural upshift or another cyclical spike. SoftBank's founder has dismissed worries of an AI bubble and signaled confidence in a long-lasting technological revolution. Yet the recent volatility in AI exposed chip makers and the pressure on smaller names like Cerebras suggest that the market is now differentiating more aggressively between winners and laggards. From here, the key signals will be AI earnings guidance, the pace of custom chip adoption, and how quickly power and cooling bottlenecks are addressed, which links directly into the climate and energy story unfolding in Europe. Europe's latest heat wave is turning climate risk into a live market driver. Across France and the UK, extreme temperatures are disrupting daily life, with reports of power outages, transport delays, and event cancellations, underscoring how vulnerable Northern Europe remains to sustained heat. Record-breaking temperatures are pushing power demand for cooling to new highs and driving electricity prices to levels not seen since the recent energy crisis. Grids are under severe strain, with transformer failures and rare warnings of potential energy shortfalls, while high river temperatures and low water levels are threatening nuclear output in France and triggering operator alerts. These stresses come as Europe tries to decarbonize its energy system without sacrificing competitiveness. Current grid investment and market structures look inadequate for shifting demand patterns, and energy markets have turned highly volatile as nuclear and wind output struggle to keep pace during the heatwave. There is an active debate over whether rapid decarbonization is to blame for today's high prices, set against the argument that low-carbon, homegrown energy could ultimately lower operating costs and consumer bills. Adopting domestic clean energy is increasingly framed as a dual strategy to support growth and reduce import dependence, especially as Europe's reliance on imported clean tech from China grows and policymakers explore ways to foster local industry, including possible wind turbine sector consolidation while trying to avoid monopoly risks. Financing and scaling the transition are emerging as critical constraints. Fragmentation in Europe's banking sector is seen as a barrier to funding large renewable projects, since many lenders lack the scale to operate as global players. Policymakers are putting more emphasis on adaptation and resilience to relieve pressure on households and the energy system, but that will require sustained capital for grids, storage, and flexible generation. In parallel, demand for low-carbon construction products is rising, with customers increasingly willing to pay a premium. And Europe faces a long refurbishment cycle, as around 80% of today's buildings are expected to remain in use by 2050 and more than 80% require efficiency upgrades. Sustainable building practices are increasingly viewed as adding long-term asset value and social benefits, pointing to a structural shift in how real estate portfolios are evaluated. Climate shocks are also intersecting with the AI build-out, as data centers boost power demand just as heat waves expose grid fragility. GE Vernova's fully booked turbine pipeline, driven in part by AI data center developers, shows how natural gas capacity is being used as a bridge even as Europe pursues long-term decarbonization goals. For markets, that raises questions about how quickly emissions can fall, how persistent high power prices will be, and how energy policy will balance security, affordability, and climate targets. Key watch points now include European power price dynamics through the summer, concrete plans for grid investment and resilience, any moves toward banking or industrial consolidation to fund the transition, and the pace of retrofitting and sustainable construction. Taken together with the volatility and AI themes, Today's climate signals reinforce that physical risk, technology demand, and policy choices are converging to reshape forward return and risk assumptions. To wrap up, today's picture is one of stress rather than crisis. Tech and semiconductor volatility is being driven by leverage and product structure, with Micron's earnings set to steer near-term risk appetite. The AI story remains powerful but more differentiated as custom chips, massive capex, and real productivity gains coexist with valuation pressure and sharper single-stock reactions. Meanwhile, Europe's heat wave is translating climate risk into immediate pricing and policy questions, from power markets and grids to buildings and industrial strategy. Watching how these three forces interact over the coming weeks will be key for understanding liquidity, dispersion, and where future risk premia may need to reset. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.